All right, without further ado, let's get kick-started with the first conversation of the day, and that relates to retirement. Part of managing the whole, the process of retiring and life after retirement is the amount of investments that you make over the course of your work life. But then after you do retire, it's all about managing cash flows, and that's what we're going to be focusing on in this conversation. My guest today is Harshvardhan Roongta, certified financial planner and co-founder of Roongta Securities. As always, Harsh, a pleasure speaking with you. I will start with the most basic question. For those people who retire at the age of 60 or close to 60 who don't earn a pension, how do they manage this? Because I think for them, managing cash flows becomes all the more important.
You're absolutely right, Alex. So, in fact, when we talk about a situation where a person has retired without pension, so post-retirement, the first thing comes in is that, you will not anymore have a fixed cash flow. So, you would otherwise be getting a regular or a monthly income, which will now stop. So, your requirement is again the same thing, which is that you need a fixed cash flow to come in. You have several options that you can choose from. So, you have a corpus. Now, what do you do with that corpus? So, your dependency is essentially going to be on interest on the deposits that you make or the returns on your investment. And, one of the options that we were chatting earlier was on dividends, for example. So, since the requirement is more specific in nature, as in you want a fixed amount to come in every month so that you can meet your monthly expenses, dividends really wouldn't fit into that category because neither the quantum of dividend nor the periodicity of the dividend is known to the individual. They could fluctuate depending upon the institution which is giving the dividend out. So I guess interest payment, interest income rather, or an SWP, a systematic withdrawal plan, at least ensures the fixed cash flow. If you were to compare interest income versus systematic withdrawal plan and SWP, strictly they're not comparable in nature. However, from a taxation point of view, if you were to consider an individual could opt for an SWP, which is far more tax efficient than the interest income that they earn. So, these are a couple of options. One is, as I said, the interest income that you get on your deposits or a return on investments that you make. Dividends cannot entirely be relied upon. One additional reason being because the dividend yields are generally lower. So you need to have a very large corpus invested so that dividends alone can take care of all your expenses. So these are popularly two or three options. In the non-financial products, if you were to look at, I know of some people who prefer a rent income. So all the corpus that they have, they park it in a fixed, in a real estate and look at rent income coming out of that, which takes care of monthly expenses. However, real estate investing has its own set of nuances and limitations. So I would just generally suggest for a retail or a common investor to look into more details before finalizing anything on the rental part at least. Otherwise, financial products, there are a whole lot of options available, and most certainly an individual can construct a portfolio in such a manner that he has a mix of interest income and a systematic withdrawal plan, which takes care of the monthly expenses.
I'll come back to how one should construct their portfolio with this in mind. But I think there's a step before this, right, Harsh? When you are in the run up to retirement, or indeed when you just about hit it, there are certain things that come to mind in terms of how am I going to ration the amount of money that I get? And not everyone is blessed with having generated a large amount of corpus where they don't even have to worry about it. They can just keep pulling from what they've saved up. A lot of people have just about enough to take care of 20, 25, 30 years post-retirement. So how does one approach this? How does one understand what their spending patterns are likely to be? And should this be the first thing that you do?
Yeah, exactly. So, in fact, Alex, if you were to look at a calculation, a methodology to ascertain how much amount you're going to require at the time of retirement, or the other way around, you've already hit upon retirement now, and then you want to calculate how much time this corpus is going to last for you. There is a particular method in which you can do that, which is based on certain assumptions, no doubt. So we're going to be assuming a lot of things in that calculation, but this will at least get you closer to whatever you're going to be aiming at. So there are certain factors as I mentioned. So one is what are your monthly expenses going to be like? What is the rate of inflation pre-retirement and post-retirement as well? what is going to be the rate of return that you're going to get on your investment. There are other things. What is the legacy you want to leave behind? What are the emergencies that you want to plan for? There could be some medical emergencies that you want to keep money away for. So these are about a couple of factors that you'll have to incorporate in your calculation, and which will give you a sense. If you're planning for retirement, so you're much younger, you're say probably 20s and 30s, and you're planning for a post-retirement period, then this is the assumptions that you will put into. Take inflation into consideration, calculate the corpus that you need, how long. So you're going to estimate a longevity for yourself as well. So when you put all these factors together, you will come to a figure that you need to target to achieve at your age of 60. Now, when you're post 60, you already hit 60 now, and now there is a corpus available with you. The same factors come into picture. You put in those factors, you calculate until how much time this existing corpus is going to last. So I just repeat those factors very quickly. So because these need to be put in into the calculation. What are your monthly expenses? What is the rate of inflation? What is the rate of return that you're going to get on your investments? What is the longevity that you're expecting? Is there any medical emergencies or emergency fund that you need to keep aside for? And if there is a legacy that you need to give to your next generation, put that into the calculation, and you'll know exactly how much this corpus is going to last you for and how many years. So you can plan your expenses accordingly. In fact, when you look at the corporate, the business organization, there is a projected cash flow calculation being made. Same is the case with your individual cash flows that you can estimate.
Okay, before I get to the next point, and I want to speak a little bit more, Harsh, about medical insurance, because I think this is something that a lot of people worry about. The conundrum I think some people face is, should I take care of my own needs, or should I save up or save a portion of the wealth I've accumulated for the next generation? In terms of the advice that you would give, should you prioritize your own requirements and not worry about the next because they'll take care of themselves?
Well, Alex, invariably, if we get into the detailed calculation, you will notice that whatever corpus that a normal individual, I'm not talking about exceptional cases, but in normal, the masses would generally not have enough to take care of themselves by itself. So, at the first instance, you have to make sure that you take care of yourself, and then leave. If there is anything left, you will leave behind as legacy. So, if you were to do the actual real calculation, most of the individuals retiring or going to retire do not have enough corpus to take care of all their needs by themselves, because average life expectancy is going up. Earlier, we would see that people would exhaust their capital much before their or rather just close to their expected life expectancy. But people are living longer now, so the requirement for corpus has become larger, which is invariably not possible. So, in all certainty, wear a oxygen mask first for yourself and then help somebody else. That's the standard disclaimer that we listen to all the time in flight, and that is going to be the case for yourself as well. Take care of yourself first. If anything is left beyond that, then goes for legacy.
That's I couldn't have put it better, Harsh, and I'm hoping that a lot of people take your advice to heart. Now, coming to the point that I want to raise on medical insurance. Now, beyond a certain point, it becomes incredibly expensive to pay the premium for medical insurance. And you mentioned that this is one of the factors that people have to bear in mind. But assuming that you would normally have coverage of anywhere between 10 lakh and 20 to 25 lakh as a couple for medical insurance, how should you plan keeping that contingency for medical purposes?
So there are two parts to this medical insurance part. Now, first one is, of course, whatever medical insurance that you have taken during your working life, make sure that post retirement you continue with mediclaim. So I have had so many cases where people get wary about the high premiums that you're going to pay, because premiums definitely jump up once you get older. So beyond 60, your premiums will shoot up considerably. Now you need to also keep in mind, because the chances of hospitalization have also gone up, there is going to be a higher premium naturally. I mean, there is nothing that the insurance company is trying to extract out of you or something. It's just the claim ratio that they are trying to protect, and that is naturally because you're going to be older. There is going to be chance of hospitalization is going to be higher. Now, what people confuse with is, suppose there is a 5 lakh cover on which you're paying about 30 to 40,000 rupees as annual premium. Many people believe in the next 10 to 15 years I've anyways paid the entire 5 lakhs. So why do I need insurance at all? Well, that's not the case because insurance coverage is an annual coverage of 5 lakhs. And premium that you pay is again annual. So if you're paying a 30,000 annually, you're covered for 5 lakhs. If you exhausted your 5 lakhs in this particular year, next year again, if you have a claim, this 5 lakhs continues. So it's a 5 lakh annual cover. So I don't think you should make that mistake post retirement to look at the cost of insurance and not continue with your medical cover. The other element to keep in mind in terms of creating an emergency fund or some corpus aside for medical reasons, despite having a Mediclaim policy, is because there would be a lot of OPD treatments and consultations which are not covered in your Mediclaim policy. The policy covers all expenses relating to hospitalization, but there could be many such routine consultations or OPD treatments that you will go in for, which is not covered by Mediclaim. So yes, medical expenses are going to be very important post retirement, and there has to be sufficient provision made for that.
Okay, that's a very important point that you've raised, and I think that to a certain extent answers my question. But you know what, Harsh, I want to speak to you on another day specifically on this because I think a lot of our viewers have questions on medical insurance. I want to ask one last question on this front though. I think this is a very common belief that when you retire, you have to take your foot off the pedal and therefore not take too much risk. But is it still very important to have some portion of your portfolio dedicated towards equity, and how should you ideally make that allocation?
So rightly put, Alex. I mean, people have this notion that post retirement you should not take any risk at all and move all the money out of equity into debt. Well, in fact, given the interest rate scenario that we are in right now, which varies from say about 5% to 7%, this rate of interest or returns that you generate on debt products is not going to be sufficient to beat inflation. So while your expenses continue to go up with inflation, the returns that you generate on your corpus is going to keep depleting. So, this will exhaust your corpus much faster than what you think. So, in fact, I would say, given the interest rate scenario right now, it is mandatory to have certain portion into equity. Now, that could be 10%, it could be higher, lower, entirely dependent on individuals' cash flows and risk appetite. So, you need to be very careful about what is your risk appetite, how do you moderate and calibrate your portfolio in such a manner that you have equities, but that does not impact you in your regular cash flows as well. So you have to keep, so as I said, there is an inflation rate and there's a rate of interest that you're earning. And if you're going to earn less than inflation rate, probably 10 years down the line or 15 years down the line, you will start feeling that, the pain point at that time, maybe not today, but at that point in time. So you need to fill in that gap of the rate of interest and inflation rate by this equity, which could possibly be as a target for say 70 years of age. At 60, you're investing for 70 to fill in the gap between the interest rate and inflation rate. So yes, there has to be some allocation depending on each individual profile. I wouldn't be able to give a thumb rule for this, but it was entirely dependent upon each individual's existing cash flows, corpus, and the risk appetite.
Absolutely. I think that works. Harsh, it's been an absolute pleasure speaking with you as always. Thank you so much for taking the time. And I do look forward to speaking to you once again to get your view on how to manage medical insurance and medical expenses post-retirement. We'll couch that for another day. All right.
Yeah,
well, I hope that conversation was helpful to you. If you've got any questions, do write to us on any one of our social media platforms or indeed on the WhatsApp number that you've seen on the screen. We're slipping into a short break, but we've got more on the other side, so do stay tuned. Welcome back. We're in conversation with, and there has been a query that was sent in by one of our viewers, Harsh. I must say that it was a little bit of a demanding query because there are quite a few boxes that Mr. Krishnan wants you to tick when he's asking this question. He's saying he's looking for a mutual fund category and he's asking which would be the best one to invest in that would provide a retiree a steady SWP route. Incidentally, this is something we spoke about in the previous conversation, and this is something we should consider: safety of capital, decent GR for capital appreciation, and he's asking whether a conservative hybrid fund would tick all of those boxes and can recommend one or two suggestions that he can consider in that category, if that is indeed the category?
If you were to look at the conservative hybrid fund, you will see the equity allocation in the conservative hybrid fund would be a maximum of 25% because that's the mandate as per SEBI. Now, within that category, because it is 25% allocation, it for taxation purposes it will be a debt fund. So what happens? So one of the check boxes that Mr. Krishnan is looking for is that efficient tax rate. It might not fulfill that criteria. Now, if it's a debt mutual fund, because it has equity less than 65%, the taxation is debt, and in which the short-term capital gain is going to be taxed as a marginal rate. So whatever it is tax slab, he has to, and holding period being less than 3 years. If it's more than 3 years, then it goes to long-term capital gain, on which he pays 20% with indexation. Now, on the other hand, there is another category which has a moderated equity allocation, but for taxation purposes, it will be as an equity fund. So the balance advantage fund category, also it's known as a dynamic asset allocation fund. Now, these will have a equity allocation depending on market conditions. No doubts that the equity allocation, the pure equity allocation will also be more than a conservative hybrid fund. However, from a taxation point of view, it is categorized as equity. Now, if you see the tax implication on gains, holding being less than 1 year is 15%, and long-term capital gains being 10%, and with a basic exemption up to first 1 lakh not being taxable. So clearly, on the taxation front, you will find a balance advantage fund to be far more better than the conservative hybrid fund. As I mentioned, there is going to be slightly more equity allocation in balance advantage fund as compared to a conservative hybrid. Nevertheless, I can give him recommendations on both the categories, and he could choose whichever he likes. So within the conservative hybrid fund, I could recommend a Canara Robeco conservative hybrid fund, in which the equity allocation will be about 22% currently, or a Kotak debt hybrid fund in which the equity allocation is about 24%. Now, if you compare this, I give you other options within the balanced advantage fund category. So ICICI Balanced Advantage Fund is one such scheme that he could consider. However, this fund would be approximately 36%. Or you can look at the ABSL Balanced Advantage Fund, in which the equity allocation currently is at 5%. So, just barring of a little bit more allocation, pure equity allocation in Balanced Advantage Fund versus conservative hybrid, from a taxation perspective, the Balanced Advantage Fund is far more superior.
Okay, I think that wraps it up very neatly, and in fact, I'm sure that Mr. Krishnan will have his answer, and you've managed to tick all of the boxes. Harsh, thank you so much once again for taking the time for the lovely conversation that we had, and also the question that you just answered.
My pleasure, Alex. Thank you.
All right, on that note, we've got another interesting piece of information for you. It's a bit of an explainer. Now, you'll be aware if you watch the show, or indeed if you watch the program, or rather the channel, that last week the Prime Minister launched a service which allows you to invest directly into government bonds, and also on the shorter end into treasury bills. Now, what does this mean? It means that you're going to have access to an asset which you could only invest in through mutual funds before. You'll be able to invest in it directly. But a lot of people are not as familiar with bonds as compared to their experience with equities. And so we thought, let's break that determine bonds, and this should help you out. Listen in.